I'm just sitting here thinking which ones I want to ask that are the most important because I mean, we'll come up with 30.
Just start hammering away.
I mean, legality, right? Break down a little bit more the legality of this. Typically, from my understanding is it may not be clear, but more than 3 to 5 people in one LLC kind of becomes something that's supposed to be registered. The SEC. There's also different states that have different guidelines. I think there was also something in California that you guys had a case back 2022 or so. So maybe you could kind of, you know, distinguish between a registration, the DAO at different states, the borders, the thing, and yeah, take it.
For sure. So if you look at our platform compared to really anyone else out there, if you look at, I would say Fundrise, Arrive, Cadre, CrowdStreet, really all of the companies that you could consider competitors to Lofty, they are essentially, and this is nothing against them, it's just the truth. They are essentially funds or REITs that are buying properties and then selling them to investors, and then typically taking a cut of the rent or a management fee and really deciding on when the properties will be sold, right? They could be in some sort of GPLP structure. Our platform is completely different. We own no portion of any of the properties. We make zero decisions on behalf of the investors. All properties are owned by DAOs, which by definition are member managed, meaning there's no managing member. And so even if you list a property on our marketplace and you're managing it, once you start selling any tokens whatsoever, you can no longer make unanimous decisions for the property. So you can't just say like, hey, investors, I think it's a good time to sell. Let's sell. No, you would need a portion of the investors to vote alongside you in order for that decision to go through. And so LLC membership interests are not securities by definition. What matters is the management. And with our platform, all of the investors are active and involved in the decision-making process, from how much to rent a property for, whether to make a repair or not, converting a short-term rental to a long-term rental. And so this active investor piece is a very important distinction between Lofty and any of the other platforms that I mentioned before.
I have a quick question on kind of somewhat related to what you were saying there. I know I understand that DAO, the decentralized autonomous organization, which allows you to have more people. But actually, I want to get into, let's say you sold 55% interest. It's now you can't decide you want to put an ADU on that property, right? You have to get approval through all the members.
You can't decide if you want to put in an ADU after selling one token.
Okay.
Yeah. Once you start selling any tokens whatsoever, you can no longer make unanimous decisions for the property.
It goes for voting, right?
Yeah, it goes to voting, correct. The process is very smooth. Most of the day-to-day decisions investors voted on in like an original survey they took on our platform to allow the property manager to make day-to-day decisions on like the nightly rate for an Airbnb or whether to make a repair or not. But something like adding an ADU, converting a short-term rental to a long-term rental, selling the property, all of these decisions must actually go to votes. And just going into the ADU aspect, we do have a capital call mechanism where when we launch a property, we mint like 1 billion tokens. And so if there was a capital call for an ADU and that costs $10,000, we can unlock some of the reserve supply, and anyone that paid for that ADU would receive those additional tokens. Everyone else would have their ownership diluted. So this is something that we've done on multiple occasions, whether for repairs or ADUs, solar panels, a number of different instances.
That was my question. Actually, you just answered, which was great. Is that based off an after repair appraisal or an as improved appraisal? Secondarily, another one got done.
It would just be based on really like the cost of the ADU. So if the ADU costs, $20,000 just for a round number, $20,000 worth of new tokens would be sent either to the owner of the property if they're going to be paying for the whole thing, or they can open up a capital call to where any investors can contribute to that capital call. In this case, $20,000, they would receive new tokens, and then anyone else that did not contribute would see their ownership diluted.
I hate that word. Yeah.
They contribute to the capital call.
Yeah. Well, I mean, in this case, it's hard. I guess it's kind of hard to say it's a dilution because they're paying for those tokens, fair amount, I assume. Yeah, there's more tokens, but they were paid for. I guess it is.
They were paid for initially. You could even say that the ADU paid for, it might cost $10,000, $20,000 would increase the property's value more than that. And so in turn, those initial tokens, even while slightly diluted, would actually be worth more.
And it would potentially add cash flow, which all the token holders would benefit from.
Exactly.
Yeah, more, Joe? I'm sure you got more questions. Fire away.
Just to sum that up, you're taking the position that each member is also, I guess, a manager with a voting right, and doesn't matter how many are in there, and that's your position. Is that correct?
Correct. It's essentially really the same thing, kind of like I mentioned earlier, as a group of friends that come together and form an LLC and then purchase a property under that LLC. We just make it easier for more people to come together and do that without all the annoying paperwork. And then we make it really easy for people to go in and out of their investment, because you could buy a token and you could sell it immediately after. And so there's no lockup period in this case. And so really all we've done is improve the process of owning a piece of an LLC. But again, it's much different because each owner has a say. There is no managing member. It's completely member managed. If you buy one token, you have a say in how the property performs. Just, this is somewhat off subject, but another kind of interesting thing we've started to see is that a lot of the tenants in the properties that are renting the properties on our marketplace will actually buy tokens in the properties that they're renting. And so this is a really unique way for these tenants to actually start to build homeownership without having to sign some predatory lease option rent to own agreement. It's 400 pages long. They just go to the property page of their property. They click the buy button. They could become a part owner of that property and build up that ownership over time. And we've actually seen instances where, just for example, like the tenant of a property owned a few tokens. They actually proposed a governance vote and said, hey, everyone, I actually live in this property. I own 5 tokens. It's really hot during the summer. I would love if there was like a ceiling fan in my bedroom. And at that point, the investors got to vote to provide the tenant with the ceiling fan out of the operating reserve funds. Each property has its own like CapEx operating reserve. And of course it went through. And so this is just something that people have really never seen before. And so it's totally new, but we've been doing it for a while now to where it's really automated. And I can think of 20 different examples like the one I just named. So it is this really just, again, like kind of intimate experience between, you know, the sellers, the buyers, and the actual tenants of the property.
And on that, the ownership, as long as you maintain 51% ownership or greater, you have the majority of voting rights. So ultimately what you decide would end up going through, correct?
Incorrect. We have, again, once you start selling any tokens whatsoever, you cannot make decisions yourself. We
put it out in front of them, right? But you win the vote if you own enough, correct?
Majority.
Incorrect. So once you start selling any tokens, essentially your voting power scales down. And so we have our own essentially like governance algorithm to where whenever you sell any equity, your actual voting power would scale down too. So just to give an example, if you sold say 30% of your equity and now you own 70%, you would need about half of the tokens you sold to vote alongside you in order for that vote to go through. And so we spent a lot of time on this because again, this isn't a syndicate. This isn't a fund where one person is making the decisions. They might have 99% of the ownership, but if they've sold 1%, they can no longer determine, when the property's sold, converting a long-term rental to a midterm rental. They would need a portion of the owners to vote alongside them. One, this is for regulations. And 2, it really helps to prevent against like a bad actor. I might have given this example on our call, but someone could sell 10% of their equity and then they need to sell the property half off to pay off a gambling debt or something. That should not be possible. And it's not with how the governance system is set up, because the investors would obviously never vote for that.
Great info. That's really, really good to know.
But in that case, Max, the seller who still owns the majority of the tokens could buy them back and do that. Could he or she not?
Correct. If they bought back all the tokens, they can do whatever they'd like. They own 100% of it. They can take the property off the marketplace. They can keep the DAO. They can sell it. It's completely up to them. In the last 2 months, we've had 2 sellers propose to buy back their tokens, I think at $51 and $52 per token. Investors voted yes. They bought back the tokens. Again, we don't charge a fee for that. And now they're selling the properties on the MLS. They were just like underperforming Airbnbs. And so sellers have that flexibility really anytime.
And the only way to avoid that vote you just described where everybody agreed to $52 would be to have a buyback agreement built into it to begin with, right?
Correct.
Yes.
Yeah.
And what is there a minimum threshold above which something has to go to a vote? So, for example, on my rental property in Port St. Lucie, if I sold half or whatever, and now all of a sudden it's hard for me to make a decision. Well, my property manager said the refrigerator's broken and it's going to be $150 to repair it. Does that go to a vote?
It does not. So
What's that threshold?
Right. So typically it's, property managers will have like an NTV, like sometimes it's 500, sometimes it's 350. So those are automatically approved. And the reason for that is when you actually sign up for Lofty, you take an initial survey that asks you questions for more kind of like general things. So like, for example, if there's a repair for under $1,000, how do you want to handle it? The majority of investors chose the option to defer to the property manager's recommendation. Or another example would be like if a lease comes to an end, how do you want to determine whether to offer renewal and how much should that renewal be? Again, investors voted to follow the property manager's recommendation in that case. And so this avoids there being, 10 votes sent out for a property like per month. It's really for like the larger events. But again, like if there are multiple repair estimates that come in, that will typically go to a vote. Really, it's all up to the investors. And one of the best parts about the co-ownership model is when a vote comes up, the original seller who might have been managing and owning this property for 3-4 years, they can offer their recommendations. They could say, hey guys, these are the estimates that came in. I remember buying this HVAC 10 years ago. I've noticed that this model over the years, this new model would have been better. So I recommend choosing this model. And then obviously investors can take that information, they can make their own decision, but that seller can provide a recommendation. And that's a big reason investors love this product because they get to co-own a property alongside someone like you guys that has owned this property for a while and has really that operational experience and knowledge.
And forgive me, what if I'm the property manager and there is no third party?
Right. Which is the case quite often. It would be the same when it comes to like minor repairs and leases and things like that.
Okay. So we'd set some threshold and below which it's up to me, the property manager, I'll just get it done, and above which it goes to a vote. Okay.
Is there a period of time that the vote has to take place by? Like, can you institute 24 hours, an emergency situation like that for an HVAC repair that's $1,000 hours?
For emergencies, the vote will come back a lot quicker. Usually we like to give people at least like 4 days, sometimes a week, like a lot of the time a week. If, for example, a property is listed for sale and like an offer comes in, maybe the buyer says, I need to hear back in 2 days. We can obviously send out that vote and say, you have to get that this vote closes in 2 days. And so it really just depends on the situation.
How does an investor